As an agent and as a mortgage lender, I have a pre-approval letter. I've gone to look at houses. We have an offer accepted on the table. What happens next?
I just say one thing really fast about Kohl's or store or whatever credit cards. Everybody in the world who ever listens to this podcast, don't take those cards. Here's the reason why.
Is there anything in the mortgage underwriting experience that would make the house less valuable? And maybe the buyer doesn't care. Welcome to Strategic Wealth with Kristina. Today I am joined by Ryan Chambers and Josh Chapman. They are both real estate and mortgage professionals in the Kansas City area. And today we're going to talk through all things buying new houses, what it looks like from a real estate perspective, as well as what it looks like from a financing perspective. So thank you so much, Josh and Ryan, for joining me.
So happy to be here.
So talking about real estate, super fun topic right now. It's interesting because when the market is volatile, people always kind of look at like, well, what else can I do? And real estate is always one of those topics that is always going to be on the edge of investing, but also just part of life, right? We need homes and we need places to live for ourselves or for family or whatever the family dynamic is. So I guess what I kind of want to start with, Ryan, is in the financing process, right? Most individuals aren't walking around with hundreds of thousands in cash or even millions in some cases to just buy something outright. So can we kind of start with the financing process in general? Tell me things like having a down payment, going through the financing process, what monthly payments look like, all of that fun stuff.
We can do it all.
Perfect.
So, yes, you're right. Not too many people have X number of dollars sitting around. So, I don't know. Josh probably has exact numbers for us, but I don't know what the average home price is or a first-time home in Kansas City. But let's just say around $400,000.
Okay.
So, the old school rule of where you want to be in terms of, am I going to be able to afford this house? Is it going to work for me? Is you look at your gross income, and we always go off of gross income, and you take about 43 to 45% of that on the most. So let's just say you make $10,000 in your house. Mm-hmm. You don't want your total debts plus that house payment to exceed about $4,500. Mm-hmm. Don't exceed that number. Right now, rates are higher, so it's just a fact of life. It's just reality we get to live with. But at the same time, a house payment's going to be in the $7.50 range per thousand you finance. If that's just kind of just a rough number. So $100,000 house, $750.
Okay.
Keep doubling up from there and doubling up from there. So don't try to exceed 45% with all of your debts plus that house payment. That's
and
just
that's
a
the
good
whole
way to
house
start.
payment or just the principal? Like, do the taxes and interest?
Taxes and insurance go into what we call a debt-to-income ratio.
Got it. Okay.
And we don't want that number to probably ever exceed 45. 43 is even a safer number and a better number. But it's important if you're really going to go start the process. And if you're talking with younger clients, start preaching credit from day one. Maintain your credit. Keep your credit really good. And that's pretty easy to do. It's called pay your bills on time, and then it works out. It always kind of magically works out. You'll have a good credit score if you have traditionally paid your bills on time. There is kind of a magic mix. So if you've got an 18 or a 19-year-old maybe at home or whatever the case may be, go ahead and let them do that credit card. Go ahead and get them going on a credit card because ideally you have a mix of about three things total on your credit just to get somewhere. So like a car loan and a credit card and one other installment loan, or two credit cards and one installment loan. That kind of gets you in that range. And then as far as down payment goes, by the way, down payments can be 100% gifts. So if you've got benevolent family members, parents, whatever the case may be, you can get your down payment from a family member. But to really get in the game, you want to shoot for 3%. If you want to actually get to the first golden bucket, it's 5% down of the price you're kind of considering. And then just calling a mortgage guy like me and saying, hey, working through your numbers, working through your debts, talking through the payments. And once we get somebody in our system, we know their credit's good, we know they have an income, we can verify all these things. It's really easy just to run payments on any scenario. Like this house is going to cost you this much money per month. So at the end of the day, it's still the standard stuff: credit, income, and then your down payment. That's the three things you really have to think about.
So then, Josh, on the real estate side, as an agent, do you yourself and other agents that you know, right? Are you going to show someone a house? Are you going to ask them to have pre-qualification already, or how does that work?
Yes, or they need to be in the process of it at least, because the thing is, when you actually get down to the brass tacks and the numbers, you want to make sure that you can afford the houses you're going to look at. Right. And so until you really talk to a lender and get that idea, unless you have, $500,000 in cash or however much, you need for the house to just pay for it outright, you really need to know how much you can afford. And when you talk to a lender, they bring in things that you're not even thinking about. Like Ryan was just saying, people don't think about the taxes and insurance piece very often. They do the calculations of like, okay, interest rates are 6%. If I buy a $300,000 house, do the 6% interest, the 6% interest, and the payment's going to be X amount, which probably is going to be more than that because of, because they roll the taxes and insurance into that. Yeah. And so being pre-approved is a huge piece of it, because then you know exactly how much house you can afford, and it avoids you wasting your time and the realtor's time too. I mean, I'm happy to show people houses, but when people start dreaming big, it's hard to talk them back when they really can't afford a house that's, at a certain amount.
I think also as a seller, I don't necessarily want people, that's still my home, right? I don't necessarily want people walking around in my home who are not reasonably, So I'm like, well, wait a minute, what are we doing here? I have to keep this house clean for all these people to come look at it who might not be able to afford.
And that's out of here.
Right.
And that's what I tell clients too, is that put yourself in the seller's shoes. Wouldn't you want to know that people that are coming to look at your house can afford to buy your house? And a lot of times that kind of puts them at like, you know what, you're right. Like, we need to get this taken care of.
Right.
So
I think you brought up an interesting point about like taxes and insurance, because I think a lot of individuals, and I talk to a ton of clients who are like, oh, I'm going to do my mortgage with like Rocket Mortgage, or I don't think it's called Rocket Mortgage anymore, but whatever it's called. And it's so funny because they'll say, well, it said that my taxes were going to be X amount of dollars, but they're never, almost ever, very accurate at all. Right. I'm like, where do they pull these numbers from? Because they're not even close. How do you do it when you're working with someone?
If it's an existing house, you can just go look up the taxes. That's easy. If it's existed for 10 years, 5 years, 3 years, whatever, if it's new construction, we kind of have an equation we use. And if you really want to get to the brass tacks and be super conservative, brass tacks. Why do you say brass tacks? No, I'm going to keep saying brass tacks. Anyway, you could take the sales price times the assessment rate in Platte County, Clay County. Most counties in Missouri, 19% is the assessment rate. You can go look up the mill levy and then take it times that mill levy, and you can get to the penny what we think the taxes will be. I know personally that the assessors are just so happy to go out and find every new construction house that's even remotely close so they can get it on the tax rolls. So finding the mill levy is not hard. Finding that, we would figure that out for you. And that's a fun thing to talk about. So when we tell people like, hey, before they've even found a house, estimate taxes at X number of dollars, it is, even after 25 gazillion years of doing this, it's kind of funny how you can take a house on one block compared to a house on another block, and the taxes are wildly different. Because, let's just say like you're in the state line area and you got a house on the Kansas side and a house on the Missouri side. You could see two way different tax rates, but it's still essentially the exact same area. Different school districts, of course, but we just kind of guesstimate in the very beginning what your taxes are going to be. I've been doing this a long time, so I have a pretty good guesser. But at the same time, if they're looking at existing homes, we can go look at the exact tax rate.
So I'm writing down two things because I have two thoughts for you, and I want to write both of them down because I don't want to forget one. But I want to start with this. So in a new home, this is something that I see happen with clients a lot, and so we kind of talk through this. And I know that you will know way more, both of you will know way more about this than I do. When you buy a new house, often the taxes that first year are based on the value of the lot. And so you might have an escrow calculation based on a much lower tax figure. So then year two, you have this dynamic of not only making up for an underpayment in year one, but also making year two correct. And then in year three, you're done with fixing year one, right? Can you kind of talk through what I'm butchering?
You're not
explain
butchering
it better?
You've gotten really, really close right there. So it's just an equation, right? We always want 2 months of your taxes and insurance in an escrow account. So let's just say you bought a brand new house. It just got done today. Well, the assessor is going to say it's worth X, but they do prorate that based off of your certificate of occupancy date. So it's, what is it, April 15th, let's just say for round numbers. They're going to say the taxes for this year, and they're artificially lower because than a full year because you just got that certificate of occupancy. So at the end of this calendar year, your taxes might be 3/4 of what they normally are. Or if they don't get around to actually getting them on the books, that's when it still looks like it was just that raw piece of land for half or 3/4 of a year. So you seemingly pay in all this money. The first year, you might get a huge escrow refund because it looks like there's too much money in your account. But then they figure out that second year, oops, we shouldn't have given them that much money back. So now there's a shortage. So just the escrow function itself is nothing more than an equation. We want 2 months of taxes and 2 months of insurance. And to get even more boring, just remember, taxes are paid at the end of a year. Insurance is always paid in advance, so you've got a post-pay and a prepay situation. You won't really be able to even get that tax information until the tax bill comes out. Now, if you're a really proactive homeowner and you have a mortgage, you could go, here's my tax bill, do an escrow analysis. Nobody ever does that, so they wait till they've actually been paid. Then the mortgage lender like me freaks out and says, we don't have enough money in this guy's escrow account, so they send you a big bill and they let you make it up over the 12 months because by law you have to allow customers to pay into that escrow account over 12 months. So then they finally kind of get it halfway right sized by the second year. But then by that third year, maybe there's some more just, we don't know where the numbers are. And if the taxes jump up, people see this all the time. It happened like, 5 years ago, Jackson County, everybody freaked out.
Yes.
Like their taxes went through the roof. Everybody's mortgage payments probably shot way up because a lot of times they're just making up not just the tax increase, but they're also making up for an escrow shortage as well. So it's 2 months, no matter where you're at in the year. We could do the equation. Let's do it for fun. So let's just say we bought that brand new house today. We just got the certificate of occupancy. You're going to make your payment in June. And you're going to pay in for 6 months. Now a whole 12 months tax bill's due, so you're 6 months short already. Plus we want a 2-month cushion, so hypothetically we would start that account with 8 months in it. So say they pay the tax bill, they do the equation, and they say that thing's, always has to have the 2-month cushion. The new taxes are X number of dollars, and if they're short the 2 months, they're going to have to make that up to where they feel like they have the comfortable cushion of the 2 months inside of the escrow account. I know that was a little long. We could show you on paper, but at the end of the day, they're always just trying to keep a 2-month cushion of taxes and insurance, and it happens in insurance too, not just taxes. So you make a claim one day, your insurance goes through the roof the next year, and you've got the same problem. So with not just your taxes or insurance. And as long as I've been doing this, I've never really seen taxes or insurance go down.
Right. Nothing ever goes down.
So at the end of the day, you're always just going to be paying more and more and more. Feed the beast.
Right.
I always recommend, though, that if you're not really sure about it, you can always appeal the assessment when it comes out. And it doesn't hurt to do. I mean, it may not help, but it may help. So
I
agree with that. 100%.
Could it make it worse, though?
Fight the powers.
I've not seen it really make it worse before. Have you?
Well, if you show up and so you can go call your county assessor and say, how much do you show my house is worth? And they're going to say X number of dollars. Let's just say $500.
What it's actually worth, not the assessed value.
The assessed value is a percentage of the appraised value.
Got it.
Your county will appraise your house. So you say to the county, say, okay, what's my assessment? And then you can say, what's my appraised value according to the county? Well, you're not going to go in there and fight it if you have an appraisal that's 20% higher than what the county thinks it's worth. So you can only really go fight it with data to say, hey, it's not worth as much as you think it is. So it's one of those things, like Josh asked, have you ever seen it go up? Well, actually, you probably could screw up enough and be like, I think my house is worth less, but you actually give them data saying it's worth more.
Right.
So at the end of the day, though, you don't really go fight it unless you know you can try to negotiate it down a little bit.
Right.
Yeah.
And in the counties, I don't know. There's a lot of different ways. They definitely do commercial real estate different than residential real estate, but they probably want some type of proof, meaning an appraisal, comps or sales or something. Say you live out in a rural community and there's no real appraisal to be had and no real comps. Well, you could show them, well, my neighbor Bill sold his house for substantially less than you're trying to say my house is worth.
I feel like we could talk about this forever because every time you say something, I just have more questions. So let me ask you about the appraisal thing. So is there a situation where, like, for example, I'll just talk about my personal situation, right? We have to get our house appraised because we want to do a refinance. would I want to not do that appraisal? Because I guess my question is, will the county know? Because if I have it appraised and it appraises higher than what I bought it for, do I now need to worry about my county assessor knowing that I have a document saying my house is worth more?
No is the short answer.
Okay.
Because the appraisals we get as mortgage lenders are not public record. We do not share those with counties. We do not share those information with really anybody outside of the lending process. That's not paramount to getting your loan closed. So the county does not know what I got your house appraised for or what the house did end up appraising for. The county does have access to public records just like everybody else, and the county does have a subscription to MLS, so they know when sales happen, so they know what sales prices are.
Yeah.
But they don't know what your house appraised for a refinance.
Gotcha. Interesting. Okay. So I want to ask one kind of final question for this session, but I do want to come back to a different one. And I'm going to tease it a little bit. The next conversation that I want to have that will be a separate link, if you will, is I want to talk about using your house as an asset as well. But to end this one, I want to talk through from both perspectives as an agent and as a mortgage lender. I have a pre-approval letter. I've gone to look at houses. We have an offer accepted on the table. What happens next? And so, Josh, if you can go first, what happens next as an agent?
Yep.
And then, Ryan, if you can kind of tell us from the financing standpoint, what happens next?
Okay, so once you get an accepted offer, right? You have the first step is you have 3 days. If there's earnest money involved in which a lot of transactions there is, that's just showing you're putting down anywhere from $1,000 usually minimum to like 1% of the purchase price typically. To show that you're just serious about buying the house. I always recommend also on the buy side to make it refundable, because if anything goes wrong, that's not your fault, or there's ways you can get that money back, right? So you get earnest money, and that's typically like 3 days to get that turned in, and then also starting from day one of the executed contract, and this is all calendar days, not business days. So then you go into a 10-day inspection period where you can conduct any inspections that you want. So I always recommend to do, there's 4 that I recommend. Do the whole home inspection. Definitely want to inspect the sewer, because even on brand new construction, I still recommend at least inspecting the sewer lines, because they can get clogged up with things that you just don't. I mean, you can't see under the ground, right?
Sure.
And then termite, and then of course radon inspections. I always recommend those to do. And then after that 10-day period, you go into a 5-day negotiating period after the inspection. So like if there's anything that comes back on the inspection that as a buyer that you don't like, or you'd like to ask the sellers either to fix, or like, there's ways to negotiate after that. You go into a 5-day negotiation period, and then you get that taken care of. And then you go into the process after that's done of the agreements and negotiations on if the sellers are going to fix anything, or you're just going to take the house as is. It's pretty much a kind of a dead period up until closing. But in that dead period for the clients, there's a lot going on behind the scenes with the lender and with the title company, like pulling title, making sure everything's clean, and getting that all set up for the lender to get all the documents they need, any extras that they might need to get to closing. Yeah. And then you do a final walkthrough after you sellers move out. I like to do a final walkthrough as close to closing as possible. So like either even the morning of a closing, or at least like the evening before, to make sure that there's nothing crazy that happened while the sellers were moving out. I had a situation 2 years ago where we were going to do the final walkthrough, and the movers had literally like they did something in the laundry room that knocked something loose with water, and it flooded the laundry room, and it was dripping into the basement. So we did not close that, right? We didn't close that next day. They did. We stayed under contract. They fixed it. We ended up getting it, but I mean, it delayed it because of that. So you always want to do a final walkthrough. That's huge. And then you got closing day. So that's kind of the step-by-step process. I mean, there's more nuances here and there of things that can happen, but that's in a nutshell. That's how it goes.
So
that's funny though. It's like, so things happen. It always happens when you're making the biggest purchase of your whole life. I don't know why. That just is the magnet for crazy in your life is going to happen once you start buying a house.
Even if you're like a toxic positivity person and you're like, everything's blue skies and rainbows. Something
does it work that way?
All
Can you
the
be
time.
toxic
Yes, those people that are like, no matter, one of these people, I'm very close to one of them. No matter what's going on, everything's always half full, blue skies, rainbows all the time, great. And it'll be like, well, your house closing just failed because you had a horrible radon inspection or because you're in a boundary dispute with your neighbor. And they'll be like, that's fine. Everything's great. It's all hunky-dory.
Well, they believe.
And here's the thing that I like, especially for first-time home buyers. I love working with first-time home buyers because I love being a part of that life-changing thing for them, and it's really cool to be a part of that. But the thing is, I always try to tell them, be patient here because it's a lot of hurry up and wait because there are dates that we have to hit according to the contract, okay? But then once we get that, there's a little bit of dead time for again on their end.
On your side. Yeah. Well, and on their side too. But then that's when you're busy. Like you're gung ho at the beginning and then Ryan's like, "Oh, I have like 30 days to pull this all together."
Exactly.
I want to ask you about the process, but I also want to interrupt that question for a minute because one of the things you talked about was the inspection and how that can open up a renegotiation period. Is there anything in the mortgage underwriting experience that, like, let's just say, for example, in the inspection, it was like, I don't even know, something catastrophic that would make the house less valuable, right? And maybe the buyer doesn't care. I still love this house. I still want to buy this house. But maybe on the mortgage standpoint, the bank's now like, ooh, I'm not sure I'm going to get all my money back if you default. How does that kind of dynamic work if there's something that shows up in that inspection process?
Well, I see it all the time on my end. Like, for example, you get a home inspection, the seller might have been unaware, we hope, right? And not intentionally concealing something. But let's say it had foundation issues, structural issues.
Yep.
And it's bad enough to where we send an appraiser out and not just the home inspector, but then the appraiser, it shows a giant crack in the wall. I've seen it happen 100 times where an underwriter says, hey, we want to see a structural report to make sure this ginormous heaving crack in a basement isn't going to cause foundational issues. And I want to point out two things really fast, which is in the process, like a home inspection is not the same as an appraisal. Right. The appraiser's not there to do a home inspection. They're there to determine a market value. So your home inspector, and these are people like Josh would set up for you, they have to know their stuff. They have to know their what can we say on your podcast? They have to know their crap, right? So long story short is you really want a qualified person who gets it. And every house is different. And, there's a way bigger difference on inspecting a 100-year-old house compared to a house that's only built 3 years ago. So all those things come into play. Long story short, though, there are things that could come up in the mortgage underwriting. But let's just say it's not that terrible. And we've got a guy who's a little bit of a weekend warrior and he can do his own repairs, but he wants some things done by the seller after the inspection. Perfect time to renegotiate, maybe paying some closing costs or maybe paying something else, or if it warrants a change in the sales price of the home and you renegotiate. So when Josh said you get through that inspection period, you got a 5-day period for renegotiations. That's when you do renegotiations. Do we want them to pay closing costs? Do we want to change the sales price? Do we want to move anything around? Do we think that we're entitled to something? Happens all the time, but just happens. Real world example, Kansas City. We had a hailstorm 3 weeks ago. Imagine if you're under contract before closing and we know there's a huge hailstorm. You probably want to go figure out if your roof is completely obliterated or not. Happens all the time. Now, also, I can tell you, this rarely pops up for me, but if for some odd reason there is a national emergency declared between contract and closing in a certain region, whether it be flooding, a tornado happened, or whatever, and if there was, for example, Clay County, let's just pick Clay County. If there was a national emergency and a real tornado, even if and the National Weather Service and FEMA declares Clay County a national emergency zone, and I have not closed, I'd have to go get that house re-inspected before closing with my appraiser just to make sure it's absolutely okay.
But only if it's a national emergency.
Yep.
Only if that county was declared a national emergency.
So like Joplin, for example.
Joplin would have been a perfect
example.
Like, say the tornado went through the whole town of Joplin, but your guy's closing on a house 12 miles out, but it's the same county. We would have to go send out an appraiser to re-inspect all of those right before closing. That's an extreme example. But back to the real nuts and bolts of brass tacks, Josh, of figuring out like what we're really dealing with. The inspection period is your time to renegotiate.
Yep.
Okay.
And I see it happen all the time. And you might as well work towards your benefit. Now, the market's weird. 3 or 4 or 5 years ago, people were saying you can't do inspections.
Right.
I know Josh would have an
there's
opinion.
so
I know
many
you
buyers.
would have an opinion.
Yeah.
Don't ever buy anything that you can't inspect. That's
Right.
just dumb.
Right.
It's going to cost you a lot more money if you
Right.
don't know about a problem. And so even when people were saying, oh, we have to, now maybe you could say, I believe the value of the house, and you would be able to really advise on that.
Yep.
Like, the value of the house is there, guys. I'm not worried about that. But don't ever waive your inspection rights. Like, that just seems crazy.
Okay, but
talk.
if you're buying my house right now, don't listen to Ryan.
Don't listen,
Because the
that's
buyers
right.
for our house waived inspection.
They
But my
accepted it
house
as
is much
is.
newer, so
Right.
So,
Your house is only 4 years old.
There's
I think- yeah.
always,
Like, hang
there's
on.
always like, okay, I feel comfortable with this.
Sure,
And it
sure.
doesn't prohibit them from doing their own inspection. They just can't come back and ask you for
Right.
stuff. You know
Very-
what I mean?
very true.
So don't ever just like not do an inspection at least.
Yeah.
Take your grandpa or a
Yeah.
handy person
Yes.
or somebody to
Yes.
at least walk through that house
Right.
with
sure.
you that you're really going to trust to
Yeah.
get something done. So,
Okay, so we've made it past inspection and renegotiation. Now, what do I owe my underwriting team? What do I do? Cash flow? I mean, tell me all the things.
Yeah, jumping back for 12 seconds, which is once you're under contract, that's when we really go to
Yeah.
work as a lender and that client together. I start saying, okay, send me your current pay stubs, send me your current bank statements, send me your W-2, send me your driver's license. Let's start talking about insurance. Let's start talking about everything. So I start gathering documents in that 30 days. I start going to work on that. I do not have any dead time. So from the day the contract is executed to the day we close, it is duck under the water. My feet are moving.
It's a great image.
all things being equal there, though, let's talk about that. Closing cost on average. Now, there's 2 different categories, right? They're all settlement charges, and because it means you've got to bring the money to close. But there's a difference between closing costs and escrows / prepaids. So if your payment includes your taxes and insurance, meaning you are escrowing, you're going to bring that money, like that 2-month cushion we talked
Yep.
about, and you're going to have to get your escrow account right from day one. So that is the escrow portion of your total settlement charges. But just closing costs, the underwriting, the appraisal, the title fees, ballpark $2,500 in the state of Missouri.
Okay.
Kansas has a little higher recording fees. They used to have a mortgage tax. I know other states do things way differently. Like, there's lots of mortgage tax, there's lots of mortgage stamps, there's all kinds of other fees in other states and other territories. Certain states you have to get an attorney involved. So in our general Kansas City market, $2,500 is a safe number to just say closing cost. Escrows and prepaids, depending on the price range of the house. If you buy a house that the taxes are $12,000 a year, it's going to be expensive because you're going to have to make up that escrow account, and it's at least $1,000 a month, right? So long story short, $2,500 for the closing cost, and I would say if you just get a ballpark of the taxes and insurance, you're going to at least bring a year's worth of insurance in and a couple months of each the taxes and insurance after that. So, let's just say for round numbers, another $3,000 or $4,000 there, roughly speaking.
Okay.
And you do get a credit at the end. Like, when you go to closing, the seller owes you taxes for that year.
Right.
Right.
So
Because
you're
they've had
gonna,
it in their escrow.
right,
Correct.
yeah, and you pick up the tax bill at the end of the year, so they owe you up until the day you close.
Okay.
So on new construction, just to make it more complicated, say it was just the land, the sellers work out great, like the home builders, because they're only prorating based off of
The land,
raw
not the
land, but
house.
you're going to have a real tax bill. So you don't get the credits on brand new construction as
Sure.
equally.
Right.
So, but at the same time, yes, that's when you're going to show up. And you don't show up with any of this money, at least with lenders like me, you don't show up with any of this money until the day of closing. So that's when
Right.
your down payment shows up.
Yep.
That's when those closing costs show up. We don't ask for money up front, but, there are appraisal fees. You're going to probably pay your home inspector at the time of
Right.
inspection, though. And you're going to pay for any of those extra things besides that. If you're going to get a sewer scope, you're going to pay for that. If you want to get a specialty inspection, you're going to pay for that at the time
Sure.
of that happening. But
Okay.
then you don't bring the rest of the money till closing.
Gotcha. So, give you all the documents, everything you ask for. You're submitting it to like an underwriting team. They're saying, yes, this person is capable of doing this. How often does it happen? I always hear these stories, and I have to tell you a little sidebar real quick because I know I'm making long story longer. But every time I go to a store, every time, Do you need a Kohl's credit card? Do you need a Costco credit card? I always tell them that I'm in the middle of closing on a house every time because I want them to like leave me alone and not badger me to get this credit card.
You have to say it? Just
because
say
if
no.
I know, because they ask like 12,000 times. Kohl's is the worst. I love Kohl's, but literally I counted one day, this lady mentioned it 8 times to me. 8 times. I'm like, I just want to buy these gloves for my kids.
Gotta get her name on the board in the break room,
right.
bro.
And
like, I don't think that lady, she has got no quit. I wish she was selling something else besides a Kohl's credit card.
I'm like, you are
my
so
God.
tenacious. You would be so great at so many things, but like, I just want to buy these gloves. But so that's my excuse. I tell people I can't. I'm in the middle of closing. Because how many times does it happen that someone's in the middle of this underwriting and then they'll be like, oh, I just bought this car.
Hand to God, I've had a guy buy a dump truck like 3 days before closing. I'm like, bro, you're killing me. And it wasn't like a little dump truck. It was a $150,000 dump truck. Yeah, anyway.
One of my first clients I ever had, he ended up killing a deal without realizing it because we told him, don't buy anything, no huge purchases. He goes out and buys a brand new Suburban. It's like, and the lender came back and said, I'm sorry, we can't do it.
This guy's ratios don't work.
What does your financial profile have to be like that when someone says don't buy anything, you consider a $60,000 car nothing? Like that's what I want to know. Like,
what's sad is he wasn't
world?
thinking about it because of whatever. But
Right.
I wish all my borrowers were in a financial situation where a $60,000 vehicle purchase would not affect their underwriting capacity. It happens far too often because we have to pull a report.
Right.
Can I just say one thing really fast about Kohl's or store or whatever credit cards?
Yes.
Everybody in the world who ever listens to this podcast, don't take those cards. I don't care how much of a discount you get on your clothing purchase or the purchase that day. Here's the reason why. They have notoriously, store credit cards, the lowest credit limits. They're like, hey, apply for a store credit card and we'll give you half off your purchase. They give you a $250 limit or a $350 limit. You can never not look maxed out on that Kohl's credit card. So actually, those credit cards, I see ruin more people's credit than ever help.
Because if they give you a $250 limit and you put $200 on it,
it's maxed out.
You look like you're 80%.
Yeah, you look like you're completely overutilized, 100%.
Yeah, that makes sense. I never thought about that, but that makes sense. And I will tell you personally, I don't even remember what store it was. It was like Old Navy or something probably. When I was like 18, didn't know any better, and it was like $600. I thought I was big time with my $600 Old Navy card.
On a budget.
Luckily, very quickly, my dad was like, what are you doing? Stop right now. But that's a good note. I didn't think about that. Like if you spent anything, even if you only spent $100, you're still.
Offer to buy him some jeans to make up for it? Like, I will.
I don't think he's hip enough for Old Navy jeans. I don't think he would.
I can't see Bruce wearing anything with bedazzles on the butt or anything. That doesn't make any sense.
There's a reason we focus on wealth and benefits and not fashion. And
I like
because he's good at that part.
He's good at that part. And thank God for the women in his life that keep him trying to look a little bit fashion forward if they can. But
so that's my only PSA, hot take. Don't get a store credit card, period.
Good to know. Okay. Love it. So thank you so much for this conversation. We're going to continue in some different episodes with some more ideas and more thoughts. But thank you two so much for your time. I really appreciate it. And if you are listening to this and you have any questions about anything real estate or lending involved, I would love to connect you to both Ryan and Josh. You can email us at info@rallywb.com and I will pass along their information. If you have any questions for them or need anything at all, it'll also be posted on the screen or in the title of the show. So thank you so much.